Hey students, again, welcome to Accounting 1105, Financial Accounting 2. We are doing over Learning Module 2, which is going over Chapter 11, Current Liabilities and Payroll. This video is going to be discussing payroll and payroll taxes specifically. So in accounting, payroll refers to the amount paid to the employees for services they provided during a particular period. Now, it could be a week, 2 weeks, or a whole month. A company's payroll is important. It's important because payroll and related payroll taxes significantly affect the net income of most companies. Payroll is subject to federal and state regulations. And of course, good employee morale requires payroll to be paid timely and accurately. I mean, who can ever remember a time that their paycheck was late? I mean, you have bills to pay, right? So you want to make sure that you pay your employees timely and make sure that you report their payroll accurately so they get paid the correct amount. So those are very important. And so let's jump right on in and let's start talking about the liability for the employee earnings. So employee salaries and wages or expenses to an employer. So salary and wages, those are two terms that sometimes get used interchangeably. Well, in the accounting world, they do actually have different meanings. So salary usually refers to the payment for your managerial and administrative staff, usually your staff that don't get paid by the hour. They get paid pretty much a flat rate regardless of how many hours they work. So obviously, if they work under 40 hours, they would use sick or leave time. If they worked over 40 hours, well, they don't get what they call overtime. So they just get paid a flat rate. Now, your wages, refer to the payment to employees for services that are based on like an hourly rate. And those employees only get paid for the number of hours they worked. But the benefit to that is, and if you only worked, 20 hours, then you only get paid for 20 hours. Most wage employees don't normally come with sick and vacation leave benefits, so you only get paid for the hours you work. But the plus side to the wages side of the house is if you do work over 40 hours a week, then you do get that wonderful time and a half called overtime. So the salary or the wage of an employee may be increased by bonuses, commissions, profit sharing, or other adjustments like a raise. So let's look at this example really quickly, just to kind of like get our heads in the right space when talking about salary and wages. So companies engaged in interstate commerce must follow the Fair Labor Standards Act. And this act is also sometimes the federal wage and hour law, and it requires employers to pay a minimum rate of time and a half, which is 1.5 times the regular rate for all hours worked in excess of 40 hours. So some exemptions are provided for, like we talked about, the executive and administrative and supervisory positions, and those usually end up falling under the salary section, so not the wage section. So that's why they are considered exempt. So increased rates for working overtime. Nights or holidays are common even when not required by law. So what that means is the only thing that's required by law to pay is overtime when you work over 40 hours a week, which is that time and a half rate, so which is 1.5 times your regular salary. Increased rates for nights or holidays are common, but they're not required by the law. So these rates may be as much as twice the regular rate, but those are just incentives that some employers may offer their employees to get them to work undesirable shifts, as I may call it. Nobody wants to work holidays, and very few people enjoy working nights. So there's a lot of companies that they have 3 shifts. The third shift usually gets paid maybe a little bit higher rate than the other 2 daytime shifts, because third shift is usually what they also call the graveyard shift. So Let's illustrate by computing an employee's earnings. So assume that John T. McGrath, that sounds like a very country music type, like he's a country music person, John T. McGrath. I don't know. Okay, so, but he's a salesperson, all right, and he's employed by McDermott Supply Company. So McGrath's regular salary is $34, or his regular wage, excuse me, is $34 an hour. So he gets paid $34 an hour. Any hours that he's worked in excess of 40 hours is going to be 1.5 times that regular rate. So if you take 34 and you multiply it by 1.5, okay, that's going to give you his time and a half rate. So if his regular rate is $34 an hour, then his time and a half rate is going to be $51 an hour. So McGrath actually ended up working 42 hours for the week that ended December 27th. And his total earnings totaled out to be $1,462 for the week. So this is how they came up with that. First, they started by taking the 40 hours, okay, and multiplying by his regular rate of $34. And that came out to a total of $1,360. Now he worked 2 hours overtime. So they took that 34 and they multiplied it by 1.5, which equals $51 an hour. $51 an hour times 2 equals $102. So they took that 102 that he earned in overtime and added that to his regular rate of 1,360. And that's how they came up with his total earnings of 1,462. So that is overtime in its most simplest form. Now, we have deductions from employee earnings. What? Have you heard the terms gross pay and net pay? Like sometimes I'll ask you, what is your gross pay, which is your pay before taxes or your pay before deductions, right? Okay, so gross pay would be that 1,462 that Mr. McGrath earned. That would be his gross pay because that's what he earns before any of his deductions came out. Now, after deductions are taken out, that's what we call your net pay. And that's also called your take-home pay. One of the most, your biggest deductions is going to be your income taxes. Everybody is subject to paying income taxes, and that's usually the largest deduction. So employers, now they normally withhold a portion of employees' earnings. So let's look right here. So when you normally go get a job, you fill out a lot of paperwork. One of the forms you normally do, and you can sometimes do it on paper, but most of them now do it electronically. Well, you probably do something online, but you fill out what they call a W-4 form. Okay. And this is a form that's going to tell your employer how much taxes to withhold, your income taxes to withhold from your paycheck and pay to the IRS and to the state, if necessary, on your behalf. So a W-4 form is formally called your Employees Withholding Allowance Certificate. So if you can see on the form, it's obviously got the employer's name, it's got a social security number and their address. Okay, so that's information where we can easily identify the employee. Now the next information is over here in box 3. Okay, box 3 is going to be your filing status. Whether you're single or married, and then we're going to talk about box 4. If your last name differs than that on your Social Security card, they want you to get a new Social Security card because they obviously want this information to match your Social Security because this is how they identify you. And then you have box 5, 6, and 7, and these are talking about allowances and exemptions. So let's go down here and let's talk more about the W-4. So on the W-4, an employee indicates their marital status and the number of withholding allowances. And that's what we're doing right here. So a single employee may claim 1 withholding allowance. A married employee may claim an additional allowance for a spouse. An employee may also claim an allowance for each dependent other than the spouse. So each allowance refunds the federal income tax withheld from the employee's pay. So in Exhibit 1 indicates that McGrath is single, and thus he's only claimed one withholding allowance. Okay. The federal income tax withheld depends on each employee's gross pay and their W-4 allowance. Withholding tables issued by the IRS are used to determine amounts withheld. So right here is a withholding table. Okay. And it starts out to where it's by filing status. So we would pull up the one that's for single for Mr. McGrath. Okay, so we start out by determining what is our filing status. He said single. So we pull up the table for single. It's a weekly payroll period. So we want to look at for the week, but for a weekly payroll. And next what we do is we come over here and we find out their salary bracket. So it says in each row is the employee's wages after deducting the employee's withholding allowance. Okay, so each year the amount of the standard withholding allowance is determined by the IRS for each. For ease of computation, and because this amount changes each year, we're going to assume that the standard withholding allowance to be deducted in Exhibit 2 for a single person is $81, and that's for 1 week's pay. So and if withholding allowance, if they had a two, if they claimed two, because they're married, then it would be the 81 times 2, which is $162. So we're going to continue on using Mr. McGrath. So to illustrate, Mr. McGrath made $1,462, right? Because he worked 42 hours. Remember that calculation. McGrath's W-4 claims one withholding allowance of $81. So we would take the 1462 minus 81, and that gives us the amount of wages after the withholding. Okay, so we take that 1381 and we come up here and we figure out what bracket he falls into. Okay, and this is going to tell us how much taxes to withhold and pay on his behalf. So after the person's withholding wage bracket has been computed, the federal income tax to be withheld is determined by doing the following. Okay, so we're going to start with step 1. McGrath's wages after deducting one standard IRS withholding allowance was $1,381. Therefore, the wage bracket was $832. So we determined the wage bracket, which matches up here. All right, now, so we go to step 2, compute the withholding for the proper wage bracket using the directions in the 2 right-hand columns. That's this column and this column. All right, so first thing I want you to look at is this column of excess over. Okay, so for him is of excess over $832. Okay, and then I want you to come over here and look at this. Then it's going to be 22% plus $87.34. So for McGrath's wage bracket, the withholding is computed as $87.34 plus 22% of the excess over $832. So the first calculation you're really going to do is you're going to take the 1381, which is his wages after the withholding. So we're going to take 1381 and we're going to subtract 832 because it's only what's in excess of 832. So we want the difference between his wages after withholding minus 832. So we're going to take 1381 minus 832, and then we're going to multiply that by the rate, the tax rate, which is 22%. All right, and that gives us a total of $120.78. And then we're going to add that because it says 8734 plus the 22%. So we've calculated the 22% in excess of 832. We've calculated that as 120.78. Then we're going to add it to 8734. And so the total withholding from Mr. McGrath's weekly wage is going to be $208.12. Now, employers may also be required to withhold state or city income taxes. The amounts to be withheld there are determined by state and by city. So I do know in the state of Georgia, the state does withhold state income taxes as well. But then city would be based on where you lived in the state. So not all counties and not all cities also have income tax. So let's look at this example. Let's talk about Karen Dunn's weekly gross earnings for the present week. They were $2,250. Dunn has 2 exemptions, all right, and using the wage bracket withholding with an $81 standard withholding allowance for each exemption, what is Dunn's federal income tax withholding? So we'll go ahead and open that up and let's look at it. So it says she has 2 exemptions, so she has 2 allowances. So first thing we're going to do is we're going to go ahead and multiply that out, and that's 162. Okay, so we're going to take her total wage payment, and we're going to subtract out the allowance of 162. All right, so the subject for withholding, all right, is 2,088. Okay, those are her wages after withholding has been subtracted out. This is the amount we're going to look at that table to see which wage bracket she falls into. So we're going to scroll back up to that table, and it was $2,088. So she's in the next bracket down here. Okay, she's in the next bracket down here. So I know I'm going to take that $2,088. I'm going to subtract out $1,692, and then I'm going to multiply that by 24%, and then I'm going to add in the $276.54. So let's look at what they did down here. All right, so they did the calculation right here, the 24% of excess over $1,692. So they took the $2,088, subtracted $1,692, and then multiplied that by 24, and it gave them, and you can see right here, they have a little star out by it. You can see it right here. There's the calculation. You can kind of see it out for you because I'm a visual person too. I love the visualization. So the 2,088 minus the excess. This isn't an excess over, so it's going to be the difference between the two. And then you're going to multiply that by the rate of 24%. And that gave us $95.04. Then we add that in to the $276.54. So the total income tax to be withheld, the answer is $371.58. Okay, so FICA. Now, what is FICA? Okay, all right. This is another type of tax. My favorite example of FICA, and it always makes me laugh when I hear the word FICA because I see this scene in my head every single time I hear the word FICA, is that episode of Friends when Rachel gets her very first paycheck from the coffee house, and she opens it up and she says, "Who's FICA and why is he getting all my money?" Well, here's FICA. FICA is your Federal Insurance Contribution Act. Is to withhold a portion of earnings for each employee, and it goes towards Social Security and Medicare. Okay, so it's kind of like a federally mandated enforced retirement savings plan. All right, now here rates do constantly change. So we do want to constantly make sure that we are up to date with what the actual withholding is for Social Security and Medicare. It was at one time, Social Security was 6.25% and Medicare was 1.4%. So if you are working in the field and that is the calculation you're using, make sure that you're using the right calculations. If you're working in a payroll department, you can go to the IRS website and easily find this information out. But for the book, we're going to continue using the calculations the book has broken out. So the book is saying Social Security is at 6% and Medicare is at 1.5% for all earnings. And so this is how this is calculated out. So again, we're going to talk about Mr. McGrath, and his total earnings was $1,462. The total FICA tax to be withheld was $109.65, and this is how they computed it. So they started out by taking 6% of the 1,462, and that was $87.72. Then they took 1.5% for Medicare, which was $21.93, and added that together. There's your so that's your total FICA is $109.65. So what an employer is usually going to withhold as a deduction from an employee's earnings is going to be his federal income taxes and his FICA tax. Now, computing an employee's net pay. So again, net pay equals gross pay minus your deductions. Okay, so if we remember, Mr. McGrath had a gross earning of $1,462, right? We calculated his federal income tax to be $208.12. And his Social Security was $87.72, his Medicare $21.93. And then he had two more deductions. Now, other deductions could, in this situation, could be like a retirement savings plan, or if you want to make a contribution to a local charity, such as like the United Fund. So the net pay is going to be his gross earnings less all of his deductions. So here's your gross earnings less all your deductions equals his net pay. And that is also called your take-home pay. So if he was cut a paycheck or had direct deposit, this would be the amount on the check or the amount on his direct deposit. Let's do an example. All right, so Karen, we're going to talk about Karen again. All right, her grossly earnings for the week was December 3rd, were $2,250. It says here her federal income tax withholding was $371.58, assuming the Social Security rate is 6% and Medicare is 1.5%. What is done's net pay? So we went ahead and took out her federal income tax withholding because we calculated that in the previous example, right? That was $371.58. So then we're going to take that $2,250 and multiply it by 6%, and that is $135. Take again the $2,250 and multiply it by 1.5% for Medicare, and that's $33.75. Add up her total deductions, and they equal $540.33. Subtract that out of her total wages, and her net pay is $1,709.67. Now, we talked about the liability for employee payroll taxes. Now let's talk about the liability for an employer's payroll taxes. Employers are also subject to follow payroll taxes, subject to the following payroll taxes for amounts paid their employees. So employers must match the employee's FICA tax contribution. So whatever FICA they withhold from their employees, they also have to pay as part of their payroll taxes. They have to match it. They also have to pay the federal unemployment compensation tax. This is an employer tax provided for temporary payments to those who become unemployed. The tax collected by the federal government is allocated among the states for use in state programs rather than paid directly to employees. Congress often revises the federal unemployment compensation tax rate, and so that's always being revised. So we would always want to look that up in real world situations to make sure we're using the most current tax rate. So we also have the state unemployment compensation tax. This employer tax also provides temporary payments to those who become unemployed. The federal and the state unemployment tax programs are closely coordinated with the states distributing the unemployment checks. The state unemployment tax rates and earnings subject to tax vary by state, obviously. So, accounting systems for payroll and payroll taxes. Okay, first of all, an accounting system is the system, whatever system and procedure you set up for calculating and recording payroll. So the payroll system should be designed to pay employees accurately and timely. It should meet regulatory requirements of the federal, state, and local agencies and provide useful data for management decision-making needs. So whatever system you set up to calculate, record, and process payroll it should meet these three requirements. Okay. Now, although payroll systems will differ among companies, there are major elements of most payroll systems that are pretty common. You'll have a payroll register, your employee's earning record, and then the actual payroll checks themselves. So let's start by talking about the payroll register. It's a multi-column report. It's used to summarize the data for each payroll period. Although payroll registers vary by company, a payroll register normally includes the name, total hours worked, regular earnings, overtime earnings, gross earnings, and then of course your Social Security withheld, Medicare withheld, federal withheld, and then any other withholding such as retirement, and of course the net pay. And then a check number. And so if the company issues direct deposit, then maybe some sort of other type of reference number used to indicate that direct deposit. And then accounts debited for payroll expense. Okay, so let's look at an example. So here we show the employee's name, their total hours, regular overtime, and their total earnings. All right. So the from this portion of the payroll register, we're going to be recording the employees' earnings. Okay, employees' earnings. So and just I had to take a sip of my water. So the column totals of the payroll register provide the basis for recording the journal entry for payroll. Now, let me explain a few things real quickly. Okay, this is setting up payroll. Okay, this is recording everything that is going to be paid out once the checks are cut, if that makes sense. So this is kind of setting up payroll. This is calculating it out and setting it up. So that's why we're going to see these in called payables. All right. So this is to record the employee's earnings. So we start out by recording their salary expense. Here they broke it out between sales and office, but it's salaries expense. Now it's an expense, so it's going to be a debit. So we can record that out. And next thing we're going to do is we're going to record the amount that we're going to pay on each employee's behalf for Social Security, Medicare, federal income taxes, savings deductions, and then any other kind of charitable donation or deduction that the employee wants. And then, of course, their net pay, which is their salaries payable. So that's going to be the net pay. So this is their gross pay. This is all their deductions. And then this is the net pay that we'll be paying out to the employees. So it's a total of their net pays. It's not each individual employee's net pays, but it's a total of their net pays. So if we continue looking at, so it's kind of a continuation. All right. So this is just a continuation. All right. So we looked at their deductions withheld. Okay. And it shows their net pay that equals the total salaries payable. That's their net pay. And then when payments are cut, the check number of that payroll check. And of course, these are the accounts that are debited, which is going to be your salary expense accounts, your sales and your office. Now, that's just recording the employee's earnings. Okay. This is the journal entry to record it. This is the payroll register used to record those. Okay. Now we're going to talk about recording and paying payroll taxes. So payroll taxes are recorded as liabilities when the payroll is paid to employees. In addition, employers contribute and report payroll taxes on a calendar year basis, which may differ. So the salaries payable is and all these are set up as payables, and they stay as payables until they're actually paid. Okay, so if you pay if you actually pay these organizations the same time you pay your employees, okay, then you could, that would be based on your payroll schedule, whether it's a weekly payment, bi-weekly payment, or you pay your employees once a month. Okay, so again, payroll taxes are recorded as liabilities when the payroll is paid to employees. In addition, employers compute and report payroll taxes on a calendar year basis, which may differ from a company's fiscal year. So so let's continue on to this example. Okay, so the all right, we'll do this one real quickly. Let's talk about this one real quickly. So the payroll register of Chin Engineering Services indicates $900 of total of Social Security withheld and $225 of Medicare tax withheld on total salaries of $15,000 for the period. Federal withholding for the period was $2,925. Provide the journal entry for the period's payroll. Okay, so we start out with total salaries as and we record that as our salary expense, and that's our debit entry of $15,000. Then we go ahead and we set up the Social Security payable, Medicare payable, and federal income tax payable, and we go ahead and record those because they're payables, so we're going to record them as credits, right? Because what is a payable? A payable is liability. Liabilities are increased with credits, so we're going to go ahead and set those payables up, and we're going to record them as a credit to each of these payable accounts. Now our debits and our credits must balance. So once we take our gross pay and subtract out all our deductions, it gives us our net pay, which we record as a credit to our salaries payable. So again, our salaries payable is also equal to our net pay, which and our net pay is our gross pay less all of our deductions. All right, so that's how we came up with $10,950 as salaries payable. All right. So let's continue on. December 27th, McDermott Supply has the following payroll data. Their total salary is $13,902. Okay, so wages subject to payroll taxes. You've got 6% Social Security, 1.5% Medicare, and then you've got 5.4% state and 0.6% federal. And that's the unemployment compensation tax. And that's what, so employers must match the employee's Social Security and Medicare tax contributions. In addition, the employer must pay state unemployment compensation and federal unemployment compensation. So when payroll is paid on December 27th, these payroll taxes will be computed as follows. So they have to match the Social Security and federal and Social Security and Medicare. So we have that calculated out here. And if we come up here, it does match what we recorded for the employee's earnings. Okay, so that's going to be the employer portion. And then we also have to calculate their state and federal unemployment compensation tax. And it tells us that the state is at 5.4%. So we calculate 5.4%, and then we calculate 0.6%. Now, if you notice, it's so if you remember coming up here and looking up here, the portion of the salaries that they're going to pay, that they have to pay unemployment taxes on is only $2,710. So that's the amount we're going to be multiplying by 5.4% for the state and 0.6% for the federal. So these are the total payroll taxes that the employer okay, is responsible for paying. So how we would journalize these entries is we will record the total payroll taxes as the payroll tax expense. Okay, so that equals $1,205.25. And then we also again set up the payables for the payroll, showing the employer's portion of Social Security, the employer's portion of Medicare, and then the employer's portion of the state and federal unemployment tax. Okay, so the preceding entry records a liability for each payroll tax. When the payroll taxes are paid, an entry is recorded debiting all of these liabilities and crediting cash. So again, what we're doing in this journal entry right here, and then again in this journal entry right here, this journal entry, we record the employee's earnings plus the employee's deductions, and which gives us the net pay, which is salaries payable for all of our employees. All right. And this journal entry, we are recording the liability for the employer, okay, which is the total payroll taxes that the employer is responsible for paying, okay. And the total payroll tax expense is made up of all of these different payables. All right. So once payroll is actually processed, when we actually pay them, we cut those checks, right? Okay. Another journal entry is going to be done offsetting these payables. So all these payables in this journal entry and all the payables in this journal entry will be debited, and a credit to cash will be issued, offsetting the total amounts of the salary expenses and the payroll taxes expenses. So we'll be cutting checks to Social Security, we'll be cutting checks to Medicare, we'll be cutting checks to the state and the federal unemployment. We'll also be cutting checks to the retirements and any other contributions, and sending payments to all of those organizations. So those checks are going to be comprised of the employees and the employer's portion. Okay. And then of course, based on how you pay your employees, whether direct deposit or checks, your offset there is going to be your salaries payable. So let's look at this exercise, journalizing payroll tax. So the payroll register for Chin indicates $900 Social Security, $225 Medicare, and total salaries of $15,000. So let's look at this. So again, this is the employer's liability, not the employees, but the employer's liability. So again, their total payroll tax is going to consist of the total amount of the liabilities. So they basically gave you, so the earnings of 5,250, so earnings of 500 are subject to the state and federal unemployment. Okay. So it told you that only 5,250 are subject to the state and federal unemployment. So you would do the 0.6% against this amount. And that's how we came up with this entry, and the 0.54% against this amount. And that's how we came up with this entry. So that's how these were calculated out. So you see here, it told us only 5,250 of total salaries were subject to the federal and state compensation tax, unemployment compensation. So the state is at 5.4%, and the federal was at 0.6%. So when you record the Social Security, the Medicare, the state and federal unemployment taxes, you add that up, and that gives you your total payroll tax expense. So another important record is the employee's earning record. So each employee's earnings to date must be determined at the end of each payroll period. This total is necessary for computing the employee's Social Security tax withholding and the employer's payroll taxes. Okay, so a detailed payroll record must be kept for each employee, and this is called the employee's earnings record. So below is an example of Mr. McGrath's employee earnings record. Employees earning records, earnings record and payroll register are interrelated. Okay, So the payroll register will just show all the employees for that pay period. And an employee's retaining is all the pay periods for that employee, if that makes sense. So the payroll register is all the employees' earnings for that pay period. All right. And employees' earning record is all the pay period earnings for that employee. So it's kind of like a play on words and mix up. But here's some examples of what they might look like. And take a sip of my water. But here it gives you the pay period, total hours, earnings, overtime earnings, total earnings, right? Total they've earned year to date. Now, this is really important. We'll talk about why that's important a little bit later. And then, of course, it also breaks out the total deductions and net pay and that they've got, and each check number for each payroll. So, as shown here in Exhibit 5, an employee's earning records has quarterly and yearly totals, and these totals are used for tax, insurance, and other reports. So now, for example, one should report is your wage and tax statement, which is also called your W-2. So anyone who's filled out a W-4 knows that every January, usually the end of January, beginning of February, you get a W-2. And that's really important because we take that to the accountant, whether it's HR&R Block or TurboTax, whatever you use. That W-2 is what helps us determine if we're going to owe any income taxes or if we're going to get a big giant refund. All right. So that's why this information is so important, because this is a breakdown, right, of every pay period and how much their total earnings and their total net pay and their total deductions. Okay. And this information is going to be tallied up and reported on that W-2. All right. So let's go down here and look at a W-2. So similar to that W-4, it's going to have your Social Security number, as well as your name and address. Okay, your name and your address and your Social Security. But it's also going to have your employer's information on it. It's going to have your employer's identification number, okay, which is filed with the IRS, as well as your employer's name and address. And then it's going to have over here some really important information. So let's look right here. In the box 1, it's your total wages and tips, right? Well, that came right over here, didn't it? So this is your total gross earnings. Okay, total gross earnings. So gross earnings, again, your gross pay is before deductions. So it's going to list your gross pay for, in box 1, this is going to be for your federal income tax withheld. In box 3, it's for your Social Security wages. And in box 5, it's for your Medicare wages. And so then it's going to come over here. And in box 2, it's going to show the total amount of federal income tax withheld. So if you look over here where we listed all the deductions for Mr. McGrath, it totals up here that we took out a total of $21,387.65 in federal income taxes from each paycheck. Okay, we totaled that up. And then we do the same for Social Security and the same for Medicare. And that information is provided on this W-2. Now, if Mr. McGrath lived in a state where the state also took out taxes, that information would be down here. Okay, but we're not discussing that for reasons that each state is different. So this information would be plugged in when filing your taxes, which is a whole different class. And if you want to take that class, it's Accounting 1125, where we talk about individual income taxes. But for the purpose of this class, I just wanted you guys to see the importance of payroll and payroll retention records, and how that information is necessary not only for the employee but also for the employer, because the employer needs to have that information because they're required by law to provide this to each of their employees so that they can use this information to file for their taxes, to show that they paid their taxes and to make sure that they don't owe any further taxes. So hopefully, if everything was done correctly, the correct amount of taxes was withheld and the employee will not owe any further money. So lastly, we're going to talk about the payroll checks. Okay, so payroll checks. Now, again, payroll checks, they can be an actual paper check, or they can be electronic funds transfer, direct deposit. So I'm not going to spend too much time on this because, but it should show you a breakdown of everything. So when you get your paycheck, whether it's an actual paycheck or it's an electronic transfer, you should get some sort of statement. They call it a payroll statement. Some people call it a leave and earning statement, and or shortly termed LES, leave and earning statement, or a paycheck or a pay stub. Okay, as so many different terms, but they all should have this similar information to where it should show basically that information from the employee record. So it should give you the current amount of withholdings, okay, your current amount of deductions, your withholdings, deductions, what they are year to date, as well as your gross pay, your year-to-date gross pay, and then the net pay. The net pay should match the amount on the paycheck or the direct deposit. Of course, there's a lot of computerized payroll systems. And, pretty much nothing's done on paper anymore. Everything's done electronically. For small businesses, a lot of small businesses prefer to use Quickbooks. Quickbooks is a great computerized program. And again, that's another class that we teach here at Southern Crescent. That's computerized accounting, which is accounting 1115. And then, of course, the larger organizations may have their own systems they set up. The state of Georgia uses a system called Teamworks for their accounting software. But a computerized system should do everything that we have already discussed and should provide all the information necessary based on what we've already discussed, this requirements for a payroll system. With every system, there should be internal controls. Okay, so the cash payment controls that we described in Chapter 8, they also apply to payroll. Okay, so these are some examples of controls. If a check signing machine is used, blank payroll checks and access to the machine should be restricted. Here at the college, Southern Crescent, our actual payroll checks are not processed on site. They're actually processed at system office and then mailed to us. But we do print some checks. Most of the checks that we print here at Southern Crescent are more for operating expenses, such as accounts payable, utilities, etc. But we do keep our blank payroll checks locked in a safe, and the software that's used to print the checks is only like one employee has access to it. So we have very limited internal controls. The hiring and firing employees should be properly authorized and approved in writing. All changes in pay rates should be properly authorized and approved in writing. Employees should be observed when arriving for work to verify the employees are checking in. So a lot of times they'll have like I'm sure some of you have used you have to clock in, you have to clock out, etc. Payroll checks should be distributed by someone other than the employee supervisor, and usually that's handled by HR. Usually so what happens is either HR handles payroll or the accounting department handles payroll. Either way, it's whoever is in charge of payroll usually distributes those checks. And then any good business should have a separate bank account specifically for payroll. So at Southern Crescent, we actually have it set up to where we have a bank account for our regular operating expenses, and then we have a separate bank account set up for our payroll as well. So that the only money that is ever in our payroll account is money only meant to cover the actual paychecks being distributed. So let's move on to employee fringe benefits. So many companies provide their employees with benefits in addition to salary and wages. These are called fringe benefits, and these include vacation, medical, and retirement benefits. So the cost of employee fringe benefits is recorded as an expense by the employer. To match revenues and expenses, the estimated cost of fringe benefits is recorded as an expense during the period in which the employees earn the benefits. Okay, so I'll click back really quick. I'm gonna feel like I need to explain that a little bit further. So what happens is instead of recording the fringe when they're used, the fringe is recorded when they're earned. Okay, because obviously as the employee is working, all right, they should be working to generate revenue for your business. So to have a better offset of the expense to the revenue, we record these fringe benefits as they're earned, because you should be there. You're earning these fringe benefits as you're earning revenue, because you're working, and you're working to earn revenue. That's what your employees hopefully are doing for your business. They're working to earn you revenue. So they're working those sales, they're working those registers, they're making those calls, whatever your business is. They're working to earn you revenue. So to have our expenses match our revenue, we're going to record these fringe benefits as expenses, but we're not going to record them when they're used as an expense. We're going to record them as they're earned by the employee. Now they can be earned. So like at the college, we get so many hours of vacation per paycheck, and so, et cetera. So many hours of sick leave per paycheck. All right. So let's start talking about vacation. So most employers provide employees vacations, sometimes called compensated absences. So, you know, you work so many weeks, and you earn up to, 20 to 40 hours of paid vacation. So you can take a whole week off and you're still paid. You're still paid for that time off. So it's a paid vacation. So the liability to pay for employee vacations could be accrued as a liability at the end of each pay period. Because again, usually how, this time is earned is it's time earned, and it's calculated by pay period. And each company does it differently. So many companies wait and record an adjusting entry for accrued vacation at the end of the year. So let's talk about some examples. So assume that employees earn 1 day of vacation for each month worked. That's not a really good benefit, but okay, we'll use that example. The estimated vacation pay for the year ending in December would be $325,000. Okay, so that's, in other words, they earned 1 day vacation for each month they worked. So every employee on your payroll is earning 1 day of paid vacation for every month they worked. So so the estimated vacation pay for the year is $325,000. The adjusting entry for the accrued vacation would be, you would then record the vacation expense and then offset it with a payable. It's when that's so vacation pay becomes the employer's liability as the employee earns vacation rights. So employees may be required to take all their vacation time within 1 year. In such cases, any accrued vacation pay will be paid within 1 year. Thus, the vacation pay payable is reported as a current liability on the balance sheet. So in other words, all this vacation that they've accrued from this date, they have 1 year to use. That's what that says. They have 1 year to use. When employees take vacations, the liability for vacation pay is decreased by debiting vacation pay payable, and then salaries or wages payable and other related payroll accounts for taxes and withholdings are credited. Okay, so you're not giving examples of that. No, they did not. So basically what they're saying is they accrue this, okay, they accrue it and they set it up as a payable. And then when it's used, so when we set up for payroll, we set it up by recording as salaries payable. So if any of those employees had used vacation during that pay period, we would debit vacation payable and credit salaries payable. Okay. So a pension is a cash payment to your retired employees. So sometimes if you have a retirement plan that you offer to your employees, and as they work for you, they paid into this retirement plan. And then after they are fully vested and they're eligible for retirement, they leave the company, and then you as employer are obligated to then pay them their pension. So you're basically, all that money they've paid into that retirement plan, you've now set up as a pension plan, and you send them monthly checks out of their pension. Pension benefits are accrued by employees as they work, based on whatever that employer's pension plan is. There's basically two basic types of pension plans. You have contributed and then defined. So a defined contribution plan, the company invests contributions on behalf of the employee during the employee's working years. Normally, both the employee and the employer contribute to the plan. The employee's pension depends on the total contributions and the investment returns earned on those contributions. Okay, so the most popular example of this type of pension plan is a 401k. So under this plan, employees contribute a portion of their gross pay to investments such as mutual funds. A 401k offers employees two advantages. The employee contribution is deducted before taxes, so then that reduces your tax liability. And then contributions and related earnings are not taxed until withdrawn at retirement. So as you're earning, you're not paying any taxes on. So it's taken out before taxes. That then reduces your gross taxable income. And then you don't have to pay taxes on that amount taken out until you might start withdrawing at a retirement. So in most cases, the employer matches some portion of the employee's contribution. The employer's cost is debited to the pension expense. And we see here, okay. And so an example here is that Heaven Scent perfume company contributes 10% of employee monthly salaries to an employee 401k. So assuming $500,000 of monthly salaries, the journal entry to record the monthly contribution would be 10% of that 500,000, which is a debit to the pension expense of $50,000, and then offset cash because the employers pay their portion of it. So that's a defined contribution plan. Now, a defined benefit plan, the company pays the employee a fixed annual pension based on a formula. The formula is normally based on factors based on the employee's years of service, their age, and their past salary. So a defined benefit plan, the employer is obligated to pay or fund the employee's future pension benefits. As a result, many companies are replacing their defined benefit plans with defined contribution plans. So that's why 401ks have gotten really, really popular. The pension cost of a defined benefit plan is debited to the pension expense, and cash is credited for the amount contributed or funded by the employer. Any unfunded amount is credited to an unfunded pension liability. So here's an example of what that looks like. Assume that Hinkle Company uses the defined benefit plan. It requires an annual pension cost of $80,000. Okay, so annually they have to pay in $80,000. So this annual contribution is based on estimates of Hinkle's future pension liabilities. Okay, on December 31st, Hinkle Company pays $60,000 to the pension fund. Okay, so the entry to record this is they go ahead and expense out the total $80,000, the required annual pension cost. It shows the $60,000 that they actually paid on December 31st, and then the remaining $20,000 of it was recorded under an unfunded pension liability. If the unfunded pension liability is to be paid within 1 year, it is reported as a current liability in the balance sheet. Any portion of the unfunded pension liability that will be paid beyond 1 year is considered a long-term liability. So there are some post-retirement benefits other than pensions. Employees may earn rights to other post-retirement benefits from their employer. Such benefits may include dental care, eye care, medical care, life insurance, tuition assistance, etc. All right, so the accounting for other post-retirement benefits is very similar to that of the defined benefit pension plan. The estimate of annual benefits expense is recorded by debiting post-retirement benefits expense if the benefits are fully funded. Cash is credited for the same amount. If the benefits are not fully funded, obviously another liability account is also credited. All right, so the financial statement should disclose the nature of the post-retirement benefit liabilities. These disclosures usually include notes to the financial statements. Additional accounting and disclosures for post-retirement benefits are also covered in more advanced accounting courses. So we're not going to discuss those in depth. It's just a mention for in case you yourself are aware of this and you're just curious about how it's recorded. Okay, so again, here's an example. I kind of already showed you guys this when we talked about current liabilities at the beginning of the chapter in that first video. So this is just an example of the balance sheet for current liabilities for Warren and Joe. So I'm not going to spend a lot of time on this because we kind of already went over this and looked at this in the previous video. But I want you to show how everything we've talked about and how it looks on the balance sheet. So of course we have our accounts payable. Then if we have a notes payable, we have the current portion, which is the portion that's going to be paid within the next year. Here's our salary and our wages payable. Okay. And this is our payroll taxes payable. So all those that we talked about, this is what it would look like on the balance sheet. And these will all be listed as current liabilities. So let's talk about contingent liabilities. So some liabilities may arise from past transactions only if certain events occur in the future. These potential liabilities are called contingent liabilities. The accounting for contingent liabilities depend on two of the following two factors. Likelihood of occurring must be possible, reasonable, or in the likelihood of occurring, are they probable, reasonably possible, or remote? And then the measurement, estimate. Can they be estimated or not? I can't say those words. All right. So the likelihood that the event creating the liability occurring is classified as probable, reasonably possible, or remote, and the ability to estimate the potential liability is classified as estimatable, able to be estimated or not estimated. I don't even try to say those words because I can't. It's just not going to happen. So probable and estimable. Okay, I tried it. So to illustrate, all right, assume that during June, a company sold a product for $60,000 that includes a 36-month warranty for repairs. The average cost of repairs over the warranty period is estimated at 5% of the sales price. So the entry to record the estimated product warranty expense for June would be 5% of the $60,000. So that would be equal out to $3,000. So you would record, first you record it as an expense, and then you would also set it up as a payable. Because it's not necessarily been paid out yet. It's an estimate of costs. So that's why we're not hitting cash. And we're just setting it up as a payable because we may have to, depending, because it's a warranty, we may or may not have to pay out the expenses for the repairs. All right. Or, to cover the warranty. So the preceding entry records warranty expense in the same period in which a sale is recorded. And if the product is repaired under warranty, the repair costs are recorded by debiting the product warranty payable and then crediting cash, supplies, wages payable, or any other appropriate account. So in other words, you you're the one that's offering the warranty, and this is how you record it on your books. So you go ahead and you sold this equipment. Okay, you sold the equipment. And now you have to account for the warranty that you sold with that equipment, and you have to account for that warranty on your books. So you start by setting up the payable for that warranty, because you may or may not have to. And of course, it does have an expiration date, because we also know most warranties have an expiration date. So that payable will only be set up based on the expiration date of the warranty on the product sold. So in this situation, it was a 36-month warranty. So you're going to have to carry that payable on your books for a minimum of 36 months. All right. And in this situation, they did it as 5% of the sales price. So they set it up for $3,000. So they went ahead and expensed it out. But they're going to set it up as payable. Now, if that customer calls in on the warranty and you have to do repairs on the warranty, then what you're going to do to record the cost of those repairs is by offsetting the payable. So you're going to, so if the total cost of those repairs ended up being $200, and that $200 was just supplies, okay, you just needed to replace a part, and that part cost $200, then you would reduce the payable by $200 and credit your supply asset, because you took supplies out of your inventory to repair the part. If it was, yeah. So that's if you ended up having to just do a refund or etc., then it would be cash. And if you had to pay an employee to do the repairs, you would credit wages payable. So we'll go do this example really quickly, so to make sure that everybody has a really good understanding of probable and estimable. So this is an estimated warranty liability. All right. So Cook-Wright Company sold $140,000 of kitchen appliances during August under a 6-month warranty. Okay. The cost to repair defects under the warranty is estimated at 6% of the sales price. So on September 12th, the customer required a $200 part replacement plus $90 of labor under the warranty. So it wants us to start by providing a journal entry for the estimated warranty expense. And then it wants us to show the warranty work in September. So let's look at both of these entries really quickly. So the kitchen appliance was sold for $140,000. Okay. So the estimated warranty is 6% of the sales price. So instantly we're going to take 6% of the 140, and we're going to go ahead and record that warranty expense and set up the warranty payable. Okay. Now, it said on September 12th, the customer required a $200 part replacement plus $90 of labor under the warranty. So what we would do here is now we're going to reduce that payable, because we're reducing it because we're kind of like we're using it up now. We had to do $200 out of our supply asset account, and then set up $90 in wages payable for the labor, offsetting the product warranty liability with a $290 debit to that payable. And so that's how that journal entry would work for both of those. So a contingent liability may be probable, but cannot be estimated. So in this case, the contingent liability is disclosed in the notes to the financial statements. So there's no journal entry. So an example, a company may have accidentally polluted a local river by dumping waste products. So at the end of the period, the cost of the cleanup and any fines may not be able to be estimated. But of course, a note to disclose that would have to be placed in the financial statements. Reasonably possible. So a contingent liability may only be possible. For example, a company may have lost a lawsuit for infringing on another company's patent rights. However, the verdict is under appeal, and the company's lawyers believe that the verdict will be reversed or significantly reduced. In this case, a contingent liability is disclosed again on the notes to the financial statements. There is no journal entry. A contingent liability may be remote. For example, a ski resort may be sued for injuries incurred by skiers. In most cases, the courts have found that a skier accepts the risk of injury when participating in the activity. So unless the ski resort is grossly negligent, the resort will not incur a liability for ski injuries. In such cases, no disclosure needs to be made in the notes to the financial statements. So let's look at this chart. So if you have a contingency liability, you have the likelihood of occurring. Is it probable, reasonably possible, or remote? Okay. If it's probable, then we need to know can it be measured? Can there be an estimate or not? Okay. If it can be estimated, then you record and disclose the liability. Okay. If it cannot be estimated, then you just disclose the liability on the notes. If the contingency is considered reasonable, possible, like it's possible, not probable, just possible. Okay, then there is a disclosure of the liability in the notes to the financial statement. There's no record of it. Okay, if the contingency is considered remote, nothing is done. There is no disclosure on the financial statements, and there is no record on the ledger. All right, so the last section, let's do some financial analysis and interpretation, okay? So current position analysis helps creditors evaluate a company's ability to pay its current liabilities. This analysis is based on the following three measurements. You have working capital, current ratio, and quick ratio, okay? Working capital and the current ratio, we discussed back in chapter 4. And it just shows you how we computed those, just to kind of give you a reminder. So working capital is your current assets less your current liabilities. That gives you your working capital. Your current ratio is your current assets divided by your current liabilities. That's the number of times your company is able to pay its liabilities using its assets. Okay. So while these two measurements can be used to evaluate a company's ability to pay its current liabilities, they do not provide insight into the company's ability to pay these liabilities within a short period of time. So this is where the quick ratio comes into play. The quick ratio overcomes this limitation by measuring the instant debt paying ability of a company and is computed as follows. It takes the quick assets and divide it by the current liabilities. So what are quick assets? Quick assets are cash, and other current assets are easily converted into cash. This normally includes like temporary investments and accounts receivable. So if we look here, we got an example for Tech Solutions, Inc. Okay. So it gives us a list of our current assets and a list of our current liabilities. It's already measured out of working capital, which was our current assets less our current liabilities. So our working capital is 3,780. Our current ratio is 1.7. So 1.7 times the assets, then we have 1.7 times the current assets than we do current liabilities. Okay. So the quick ratio would be computed as follows. We would take the quick assets, which would be our cash, our temporary investments, and our accounts receivable. So we would only take these top three because those are the things that can be converted to cash the easiest, the quickest, okay? And we would take that amount and divide it by our total current liabilities. And that gives us our quick ratio. The quick ratio of 1.3 indicates that the company has more than enough quick assets to pay its current liabilities in a short period of time. A quick ratio below 1.0 would indicate that the company does not have enough assets to cover its liabilities. So like the current ratio, the quick ratio is really useful in making comparisons across companies. So here, they've already done all the calculation and the math for us, but it's comparing Dunkin' Donuts with Starbucks. So if we look here really quickly, looking at their current ratio and their quick ratio, Starbucks would appear to be in a healthier financial situation than Dunkin'. So Starbucks is larger than Dunkin'. It has almost 25 times the amount of working capital. And such a size difference make working capital comparisons between companies difficult. In contrast, the current and the quick ratios provide better comparisons, okay, than the working capital. Okay, so in this example, Starbucks has a higher current and quick ratio than Dunkin'. Dunkin's quick ratio of 1.1, however, does indicate that the company has more than enough quick assets to meet its current liabilities. But Starbucks' quick ratio of 1.7 shows it's in a much healthier financial standing. So real quickly, we're going to do some real quick calculations. I'm just going to go ahead and break these out to keep this video from being way too long. So say your company reported the following current assets and current liabilities for the years ended December 31st, 2008, 2009. Okay, so in the first one, it says compute the quick ratio. So the quick ratio takes the quick assets and divide it by the quick liabilities. And we're going to do that for 2019. And then we're going to compare the two. So we did it for 2019 and their quick ratio in 2000, and I'm just saying 2019 was 1.8. And in 2018, their quick ratio is 1.6. So now interpret the company's quick ratio across the two time periods. So the quick ratio, say your company has improved from 1.6 to 1.8. This increase is a result of a larger increase in the three types of quick assets. We look here, obviously, these quick asset rate totals did increase significantly from prior year to current year. Okay, so that is what's caused a improvement from prior year to current year in the quick ratio. Okay, so this concludes chapter 2, chapter 11, learning module 2, excuse me. This concludes chapter 11, learning module 2. We will be doing in our next video some practice problems going over the homework assignment. And so I'll pull up some practice problems similar to the homework assignment, and I'll be showing a video on how to do some of those problems to kind of help you guys out with your homework assignment.